Good morning all and welcome to today's video. So today I have two pairs on watch and those are pound Swiss and Aussie Kiwi. So I'm going to break them down for you now just to say that there was a little entry which you could have taken on pound Swiss, but I'm going to break down when we get to the lower time frames why I didn't take that entry. A key detail which I've noticed from my testing, generally speaking, causes price not to commit, okay? And it hasn't committed, so we'll break that down for you. I think that might be a useful little mini lesson. So, why am I still looking at pound Swiss then? I shall tell you, I shall break it down from the higher time frames and then tell you why I'm still looking for this pair, even though my entry didn't shape up and price has just been kind of moving sideways since yesterday. So, on the higher time frames, we have, as I've talked about before, we have this 1, 2, 3 touch structure. We just draw it on crudely using the paintbrush tool. We have a 1, 2, 3 touch structure, and we know it's a completed structure because it also has, as well as having a 1, 2, 3, it has a 1, 2, 3 middle section, which will be relevant to the entry which I turned down yesterday when we get to those lower time frames. We then break below this area of liquidity there. I've used the wrong tool there, but we broke below that. Okay, caught people the wrong side of the market who just see price going down and down and down, and they think it's just going to keep going. So they start selling, particularly as I've talked about previously, if they believe what was previously support becomes resistance once it's broken below. You can see it comes back up. Many of them would have seen this as a retest. Okay, so they start getting short, and the majority of the time we just see price rally to the upside once we break below these standout liquidity points such as that one, because to the bigger players this just represents at discounted prices. Okay, I've talked about that previously. If something is an all-time low, I was thinking yesterday after I made yesterday's video, you may have heard Warren Buffett saying he loves it when his stocks and shares go down in price because he just buys more of them. That's what he's actually said, and that is one of the wealthiest people in the world, a multi-billionaire, saying that when he loves it when his own stocks and shares that he holds go down in value because he just buys more. So if that doesn't tell us something, then I don't know what does. Okay, so these are just discounted prices, 1, 2, 3 touch structure with a 1, 2, 3 middle section. Generally speaking, we move to the upside after those, particularly if we break below the low and wash people out, catch people the wrong side of the market, as it were, which is what we call mass psychology for obvious reasons. We then have an example of the same psychology on the daily chart as well as the weekly chart. We have that push up and that potential impulse correction continuation that I was talking about. This is very wide relative to the impulse up, but we do have to remember that this is pound Swiss, and pound Swiss does have a tendency to correct sideways for quite a bit longer than your more impulsive pairs, such as pound dollar, for example, or euro dollar, more so the dollar related pairs. Okay, but we have the same psychology here. We have the 1, 2, 3 touch structure, which taps into this sharp move down, followed by the sharp move up. As I've said previously, the sharpness often indicates that a lot of liquidity, by definition, a lot of liquidity was placed here very quickly, and then price moved to the upside. Okay, in giving me the impression that there's a lot of liquidity down here, which price will likely tap into before rallying to the upside. Okay, and generally speaking, when it taps into an area which is a sharp hook point such as this, generally the aggression with which it rallies is similar to the aggression with which it rallied last time around. And you can see not quite as aggressive, but you can see some level of aggression here, similar to some extent to what happened in the past. We also have that 1, 2, 3 touch structure, which just so happens to line up with it. What a coincidence. And we have that middle section. Okay, we have that 1, 2, 3 middle section, and I said previously about how the middle section itself also has structure within it. So we have this, we have the 1, 2, 3 middle section, which you're probably starting to notice happens generally speaking after the second touch of a 1, 2, 3 touch structure. We also have this daily area of liquidity there, we fail to tap into that, the second touch is often a near miss to that area. So we have the first touch, second touch, which narrowly misses it. Then we come back up, break the high, catch people the wrong side of the market who believe what was previously resistance becomes support once it's broken above. We break above and then break to the downside. And we even have that little mini head and shoulders pattern here. And generally speaking, the right shoulder is higher than the left. That's another tick in the box. And then, of course, price pushes down aggressively. So these are all things that I've learned to see. So we break below here again. We catch people the wrong side of the market who believe what was previously support becomes resistance once it's broken below. One of the many reasons why we don't trade support and resistance in its standard form. You can see many people thought this was a retest to get short, and they get completely washed out. So now there is no reason at this moment in time for price to come back down here, because it has done what it's needed to do. It's taken out the liquidity, and we also have that near miss. I've talked about these in previous videos. We have a near miss to this high, and as you've just seen from the structures that I've been breaking down, when we do have near misses, price will often take them out, take out the area of liquidity that price near missed to. Okay, so this near miss here to here also increases the likelihood of price pushing to the upside. We also know that the impulsive leg out of an impulse correction continuation is often of a similar length to the impulse which has preceded it. So if we measure this impulse and we assume that the correction out of it is of a similar length, and then we measure it from the break of the correction as well, because the amount of volume which is built up within the correction can often dictate how far out price actually moves. That would take us up to this trend line. Okay, so that would take us up a lot of the way. Bearing in mind this is the daily chart. If you think of these corrections as the bow being pulled back on a bow and arrow, okay, that can often indicate it, or if you think of it like as a slingshot, okay, this is kind of like the pulling back of the bow before you actually release the arrow. Okay, so the volume being built up is the equivalent of the bow on a bow and arrow being pulled back. Okay, the market needs to breathe. If you think of someone running up a hill or running a marathon, when a marathon runner runs a marathon, they would, generally speaking, need a bigger rest, okay, before they start running again, as opposed to if they've only run, say, the 100 meters. Okay, a 100-meter runner doesn't probably need as big a rest as someone who's just run a marathon. So this is a big move up. So it makes sense why we would correct sideways for a longer period of time. Just trying to analogize, because I find that that's what's personally helped me learn. Okay, so then we have that 1, 2, we near miss to that area, and then we come down and we tap into it, as I said we likely would, and then we pushed up, which is exactly what I was expecting yesterday in yesterday's video. Feel free to watch that if you would like to, learn what I was saying yesterday. We also have that middle section within here to some extent. We have that 1, 2, 3 middle section. So when we came back down and we had these 1, 2, these 3 waves, that gave me a clue that this was a completed structure and that we would likely push up, and that's exactly what happened. However, so I was looking at this for an entry yesterday, and if I just so when we got this push up, I then after this 1 hour candle closed here, this red candle, that is the basically that is when we get a move up which is green, an impulsive move up which is green. I wait for one red candle to close on the 1 hour chart before I drop down to the 15-minute chart to look for entries. That is my rule. That is the candle which unlocks the 15-minute chart. Okay, that is what we call proper time frame usage, or correct time frame usage. So I was looking at this flag here at this point. Okay, I was looking at this. You might not be able to see it if you're not familiar with how we trade. So I was looking at this for a possible entry. However, what I couldn't see, so these flags early up in the run, generally speaking, only need to have 2 touches as opposed to 3, because the volume, we don't need the volume of the first touch because the volume has already been grabbed from these areas here. That is partly why we only need 2 touch flags earlier in the run. But what we do still look for is that 1, 2, 3 wave, and within that, whoops, within that kind of 1, 2, 3 middle section, or that's what I look for anyway. Now I couldn't see the middle section here, okay? So then I dropped down to the 5-minute chart, and even on the 5-minute chart, okay, so we do kind of have a first touch there actually if you look at it, but so we have the first drive, second drive, third drive, but the second drive, once again, where's the middle section? Where is the 1, 2, 3 wave? Okay, there isn't one on either the 15-minute or the 5-minute chart. And the reason that's significant is because what I've noticed is that when these type flags don't have a middle section, I've noticed from my hundreds, possibly thousands of hours of testing, that if we break out of the flag, which we did, price generally just goes sideways like that, okay? And that's exactly what's happened. That's what I've noticed from my testing. And the rule I use, the thing I remind myself when it comes to middle sections is if you can't find the middle section within a piece of structure, you're probably trading within a middle section, okay? And that's not where we want, that's not where the impulsive moves happen. So because I couldn't find a middle section within there, I stayed out of the trade. To me, at this moment in time, this does not look like it's going to commit. It could do, okay, but this is very wide for a first flag. You know, if we have grabbed a lot of liquidity from here, from that area of value, this correction is very wide relative to the move up that has preceded it. So why is that significant? Well, if we've grabbed a lot of liquidity, then why are we building more liquidity? So then what I was doing yesterday is I was analyzing this. I was looking at little inflection points. Okay, and I was looking at this little inflection point here. So if we're building volume, we could be pushing lower. Okay, so if we're pushing lower, then what are we forming? So I'm looking at this thinking, okay, well, potentially, maybe this is some kind of middle section like that to push up, to tap into that little sharp hook point to push lower. Okay, and then we would kind of have this. I'm just roughly drawing this on, but then we would have a middle section like that which pushes lower. And the reason I was looking at that is because we have a little inflection point there, okay? A little sharp move up followed by a sharp move down, which price is near missed to. So maybe price is building volume to push lower, okay? And if it did, then I would just take this pair off of watch. So the next question I ask myself is, how could I get involved for a long? What mitigates that? Well, what would mitigate that for the longs, if we're looking for longs, is if we broke above there and we flagged above that ray line, that would imply, I'm going quite advanced here, but I think this is important. That would imply that there was not enough liquidity at this little inflection point here to send price to the downside. So we've negated the possibility of this kind of larger flag forming. And then if we just look at this on the weekly chart, on the daily chart rather, okay, we would then have, if we were trading above here, we would then have the start of this morning star formation, okay? If this candle was to close above here as well, then we would have that kind of morning star formation. So what I'll be looking for is the following, with all of that in mind, which is why I've got my forecast as such. So if we push up above that little ray line and we get a flag, so this would be like, you can see we're getting a little bit of momentum now. If we got a flag such as that, this is why I always say, an analogy I like to use is you don't always have to be first at the party to end up the most drunk. Okay, that's a little analogy I like to use. So I'm ignoring this because I can't see the structure within that. I can't see the middle sections. It just looks untidy and like it might be forming something else. But if we get the push up and the flag afterwards, then I would look to get long on the break of the flag, another flag. If we broke above that inflection point on the 15-minute chart that I was talking about, or within the flag, and then I'll be able to manage it up to this trend line and up to these highs quite easily. And then, as I say, we would have that kind of morning star formation on the, what's happened there? We would have that morning star formation on the daily chart, which would be further confirmation of the move to the upside. So I've got an alert set just above this structure just to see if we impulsively move up. And if we don't, then I will not be looking to place a trade. Pound Swiss can often be quite messy. So Not always the easiest one to trade, but that's what I'm going to be looking for, and hopefully that little mini lesson was valuable to one or two of you. So Aussie Swiss, I'm going to break this down for you now. So Aussie Swiss on the higher time frames, we have 5 minutes left of this video because I've gone into a bit more depth than I wanted to. But anyway, we have this 1, 2, 3 touch structure which taps into that high. We have the 1, 2, 3 middle section. Okay, give me a clue that that's a completed piece of structure and will likely push down aggressively, and that's exactly what happened. One of the reasons this is lower on the list is because we have a near miss to this high, but you can well and truly see that we've broken above these highs, tapped into the liquidity that was sat there, and we're well and truly moving to the downside, although we've pulled back a bit, but we'll touch on that in a minute. So I'm looking at this as a potential move down to here to complete this 1, 2, 3 to potentially, at this moment in time, then take out that near miss there and then move to the downside, and then we would have that impulse correction continuation, okay? But that is the thesis at the moment. So as I drill down, you can see that we have that 1, 2, we near miss to that area. What did I say about near misses? The price often comes back up to fill the liquidity that was there before we push to the downside, and that's exactly what happened. And then we have that 1, 2, 3 middle section. We tap into the third touch of this 1, 2, 3 touch structure, and then we push down aggressively. Okay, you can even see where we have a little 1, 2, 3 ending structure. So I'm just pattern separating here. So with that 1, 2, 3, give me a clue that that's a completed move. We push down from there. Okay, if I just go down to the 1 hour chart, I've been pattern separating every day this week. Normally in the afternoons, I listen to my Alpha Brainwaves guided meditation podcast. But this week, because I was deaf in one ear, for reasons unknown, and I need both ears for that to be effective, I've been doing lots and lots of pattern separating. So let's separate these structures. We have that little tight one there. We have this expanding pattern. Okay, so separating where one structure ends where another one begins. We then have this. You can't really see a middle section on here, but if you drill down to the 1 hour chart, or to the 15-minute chart rather, you can see that little 1, 2, 3 middle section within there. That gives me a clue that this is a completed piece of structure. We come back up to fill that bullish wick, which I talked about a lot. Then we move to the downside, so just a little bit of pattern separating there. Okay, that helps us to determine where one structure starts and another one begins. We have this little expanding here, little expanding there, little two-touch expanding with the middle section there, giving me a clue that that's a completed move. We then have a push down followed by a tight flag, which itself has a middle section there. You can just about see it. If I was to drill down to the 15-minute, you would see that more clearly. So you can separate these structures, and then we go into this larger structure, okay, which has a 1, 2, potential 3. We have the 1, 2, 3 middle section if we measure the lengths. Okay. That takes us down to here where price rejected from. It found liquidity from down here and then pushed up. Okay. So what I'll be looking for today with all of this in mind. So on the higher time frames, the sequence isn't the best. Okay. Because this is very wide relative to the move down that's preceded it. But on the lower time frames, the sequence has been nice. Tight flags into another slightly larger tight flag, into a slightly larger 1 hour flag, tight flag on the break of it, into this larger flag. The sequence is quite nice on the lower time frames, particularly for Aussie Kiwi, which can be a messy pair to trade. So with that in mind, because this correction is very, very wide relative to the impulse down which has preceded it, I'll not be looking for a risk entry where I essentially call the top. But if we just use the Fibonacci tool to measure the impulse down to the bottom of the correction, that would be about a 55, 56, 57% pullback, which in my experience is a healthy pullback for a pair such as Aussie Kiwi. I've found that typically speaking, the line in the sand on most pairs is about 50%, and if we're pulling back further than that, then price is usually coming back up to test the highs. But on corrective pairs such as Aussie Kiwi, I've found that we often pull back. It's not uncommon for us to pull back 60% of the length of the impulse or thereabouts before we move to the downside, because it's a more corrective pair by nature. So with that in mind, If we tap into the area of value, push down and flag, then I will be looking to get short on the break of the flag or within it, and then I will be able to manage it down to these lows for something in the region of 6 to 7%, depending on the size of the flag. Hope you've taken some value from this, folks. Thanks for watching, and I will see you again in next week's video. Thanks for watching. Have a great weekend.